It's been a year since Mr. Sanjay Malhotra took charge as the governor of the Reserve Bank of India. It's a year in which the central bank has had to walk a fine line between sustaining growth and safeguarding stability. In that time, Governor Malhotra has pushed the envelope on several key fronts. And we are delighted that Governor Malhotra has agreed for a special interview with India Today magazine. I'm Raj Chengappa, and this is my colleague M.G. Arul. Governor Malhotra, welcome to India Today.
Thank you very much. It's my pleasure to be here.
One of the things that you did, just before you completed 1 year's RBI, and it's been an unusually eventful term that you've had so far, that if you take a look at the global scene, global trade has been shaken by President Trump's return and, of course, reciprocal tariffs, and we've felt the weight of it the most. The rupee has weakened sharply. Inflation has fallen to a multi-year low, and yet India has clocked an 8.3% growth in the second quarter of its GDP. Now, you describe this phase as the Goldilocks period for the Indian economy. From a central banker's perspective, how real is this sweet spot? Are we genuinely in a structurally stronger phase of growth, or is this a window created by a unique alignment of global and domestic factors?
Yes, you're absolutely right. This has been rather eventful and a challenging year with all the geopolitical events, tensions, the trade fragmentation that we witnessed. Despite these external headwinds, India in the first 3 quarters, for which we have data in this calendar year, has done remarkably well, both in terms of inflation. We are in historic lows, as you mentioned, right. And even so, in growth, about 8% on an average for these 3 quarters. So we are certainly, in a sweet spot. Going forward, this year we are projecting a growth rate of 7.3%. Next year, Q1 and Q2, we are projecting a growth rate of 6.7 and 6.8%.
I just want you to elaborate on this Goldilocks word that you use. It's a very curious phrase, it's a banker's phrase, but if you could say why you saw it as a Goldilocks period and define the word. When you say Goldilocks, it has various connotations. What in your mind?
So when we say Goldilocks, in economics terms, it is, the balance of the growth and inflation. So generally, high growth means high inflation,
right.
And low growth, low growth can mean, low inflation. But we are having the best of both the worlds. We are having, low inflation and high growth. So that's a very sweet spot, to be in.
Right.
So, Governor, given that, as you said, that we are in a Goldilocks phase, the next question naturally comes, how do you sustain this? Because, sustaining this would really mean that, we have more private investment coming in, we have more jobs being created for the economy. At the same time, there are so many external factors, like you said, which can really sort of shake up the economy. We still don't have a deal with the US, so everybody's watching that. So, how sustainable is this trend? And also, according to you, what would be some of the risk factors that would, sort of pressurize it from the other end?
Yeah, so it's not, one single factor which has played out in this moment, and we have been, in this kind of a period when you talk about growth for quite some time now.
Yeah.
So if you look at, last 4 years, the average growth GDP is about 8%,
yeah.
Post-COVID. If you look at the last decade, we had an average growth of 6.6%.
Mm-hmm.
Now, this is the result of a combination of measures that the government and the central bank has taken, over the period
yeah.
of time. Number one, most importantly, it is, I think, the policy stability that has been provided, certainty, because, that's very important. Of course, now some external uncertainties are there, because of which you can see you can see some a little bit of a correction in the growth, but otherwise policy stability, financial stability, price stability, this continued focus on growth of the government and a number of reforms, as a result of which a number of reforms have been taken. Recently, GST rationalization was one of them, followed by the labor reforms. Number of PLI schemes have been launched by the government, focus on manufacturing, on employment, on jobs creation. And then the very solid balance sheets, both of the government, the private sector, and the households. Good capacity utilizations. So I think on the whole, you look at each and every sector, each and every area of the economy, we are in a very good phase, and that should help us in sustaining this momentum of growth going forward.
Right. I'd like to come and to something that you've really done and changed a lot. Is since February 2025, the RBI has cut the policy rate by 125 basis points. It is now points to 5.25%. That's the rate right now. This is striking because the last comparable easing happened, I think, in the cycle in 2019 or so, and that was a bit sharply slowing growth. This time rates have been cut despite GDP growth. So what changed in the RBI's assessment? And do you see this as the start of another process? Will we continue to see rate cuts, or this is it and you'll now stabilize?
So if you compare, with the last time that we brought down the rates as low as 5.25%, and then, it went down even further to 4%, we were in a very different situation. It was exactly the reverse, in fact, right. Because the growth was low and inflation was high.
Yeah, right.
And it was increasing. Headline, next year was more than 4%, about 4.8% in 2021, So we were heading into higher inflation, lower growth. This time around, we are having good growth, and we are having, very benign inflation. So it's primarily because of the benign inflation. Last time, it was low growth, which needed to be supported. Now, the real interest rates, as I was mentioning to you, real interest rates, especially, because core X gold is quite low. Right. It's less than, it's about going forward, because monetary policy actually works forward-looking, it's forward-looking. And so the outlook is very benign, 3.5% or so. And so real rates need to be a little lower. And so that's why, we reduced our policy repo rate by 25 basis points. Going forward, monetary policy is not, preset. It evolves. We are data dependent. We are in a neutral phase. It's for the MPC actually, to decide and see what the data points to and what we should be doing from policy to policy. However, as I mentioned, I do feel that inflation should remain benign for a longish period of time. And if that is going to remain, barring, shocks on the supply side, could be weather, could be geopolitics, could be something else, then we are in for a long period of low policy rates.
I'm just pushing it a little further in the sense that you were in the finance ministry before you took up this job. Do you see, there's always the complaint that private investment really didn't, and that's the government's complaint, not yours, that private investment really didn't live up to what it should have done after the huge rates in their income tax, corporate tax rates and everything else. Do you see that change now? Is that what you're referring to when you say private investment is up, and is that sufficient to propel growth?
Yeah, so see, as I mentioned, gross fixed capital formation last 4 years as GDP has grown by about 8%, even the capital formation has grown by about 8%. The private sector over there, as you are saying, as you have mentioned, has impeded that. I mean, it could have been much more, as you are saying, but as I mentioned, it is demand which will lead to investment and not the other way around. And with consumption continuously, growing at a fast pace, I'm quite confident that investment will further, private investment, will further grow up. Let's also keep in mind 2 or 3 things with regard to private investment. One, capital intensity, of our economy is actually decreasing because capital is becoming more productive, number one, more efficient. And number 2, there is a shift of the composition of our economy towards services sector, which is growing and which is less capital intensive. So the growths in private investment will not be as high as they used to be earlier. Number 2, some of the sectors that earlier used to witness capex, they themselves as a result of this are changing. If you look at power sector, for example, we were in a deficit situation. So to meet the deficit, obviously the capital requirements would have been much more. We are now, more or less in a self-sufficient, position, having met all the deficit. So the growth in investment is not going to be, as high in those sectors. On the other hand, you see higher growth in investment in some of the new sectors, renewable energy for one, defense equipments. Now, there's a push by the government on defense equipment, electronics, semiconductors, mobile phones. So there is a shift in terms of the sectors that we normally would have otherwise tracked for private investment. So all these things, and given the fact that, as I mentioned earlier, good capacity utilization, very healthy balance sheets of the corporates, they are poised, and similarly, the good balance sheets of the banks who are eager to lend more and more to the real economy. I think all of these augur very well going forward for private investment.
Since my colleague N.G. Arun mentioned exporters, one of the things is the currency issue. And the rupee has crossed 90 to the dollar, and yet the RBI, unlike in the past, is in no rush to aggressively defend a specific level of the rupee. At the same time, the weaker rupee, as we have been talking about, has cushioned exporters and import competing industries amid rising US tariffs. It doesn't seem to be getting any relief on that. Is the RBI consciously allowing greater exchange rate flexibility? How do you balance competitiveness with imported inflation and financial stability?
Yeah, so on currency, you see, we have a very stable stated policy that we do not target any level or any price band, and we let the market forces, which we believe are quite deep, to determine what the appropriate level of the rupee should be vis-a-vis whether it is the dollar or the pound or the euro or any other foreign currency. Our aim over there is primarily to curb any kind of an undue or a excessive or an abnormal kind of a volatility which we try to curb, or if there is some kind of unnecessary speculation which is getting built into the prices, then we come in. Otherwise, we let the market forces determine the prices, which in the long run we believe are quite efficient. The market is quite efficient, and so even in this round, while some currency depreciation may help exporters, the primary purpose is, it's not that we have made a conscious effort to let the rupee depreciate.
And why I asked you that, because if you see what happened the previous 4 years, I think close to 2% of the GDP was spent on shoring up the rupee and keeping it at a rate that the RBI and the government thought was fine to help India. So should Indians now get used to a structurally weaker rupee? Is that the policy going ahead, that look, we're not going to intervene, barring, as you said, major fluctuations, but generally we believe that that's the direction we should be heading to?
I don't think, first of all, I don't think there is any major change
Right.
in the policy of the RBI to intervene. As I mentioned earlier, the policy has been very stable over the last few years, and it's only undue excessive volatility that we try to reduce. Secondly, as to what levels the Indian economy should be prepared for. See, over the years, I think there is this volatility which will continue to happen, which we have witnessed even earlier. So it's not something which is new or our economy is not prepared for. I may mention that ECBs are today 76% hedged. So people are already they already factor in and they are prepared for this kind of volatility. Last 10 years the depreciation has been about 3% on an average, 20 years it has been about 3.4%. So it has come down, the depreciation on an average has come down, and we believe that even going forward the depreciation levels should not be significantly different, maybe it should be on the lower side, given the fact that inflation now in India is going to be lower vis-a-vis the other economies. And why we depreciate is because one of the major reasons thereof is that there is huge there is a difference in the inflation. While advanced economies like US, they target 2%, we target 4%, we were higher than 4%, as I mentioned we were 4.9%. So this differential in inflation will, as long as it is there, our currency will depreciate. But going forward we are quite confident. We have a very robust, strong external sector position. We have 11 months of import cover for goods, as everyone knows, and we are about we have 92% in foreign exchange reserves vis-a-vis our short vis-a-vis our debt, external debt. External debt is about $750 billion US, and we have about $690 billion of foreign exchange reserves. So we are very comfortable in meeting our external sector liabilities, whether it is on the current account, whether it is on the capital account.
And do you expect this recent GST rejig to have really a lasting impact on consumption and of course compliance in the next few quarters?
Certainly. I mean, it's already happening. We have seen that to a great extent. It has increased the purchasing power of the people by reducing prices, and to that extent we will certainly continue to see good growth in consumption. The monetary policy easing that we have been doing for now about almost 10 years, that should also help increase and boost consumption. And most importantly, I think the focus that the government has on growth, number one, and number two, structurally the way the Indian economy today is poised with a good, very good foundation and in a sweet spot, as we say, that should continue to help us growing for a long period of time.
And how do you see this reflect? We saw Q2 at 8.3%. How do you see this reflect in the next quarter's thing? How confident are you sustaining that?
We have given our estimate 7.3% for this year as a whole. Of course, you are saying some of the forecasts set a little higher, so we stick to the latest forecast that we have for this year. 7.3% is very robust, very strong despite external headwinds. And next year again 6.7 and 6.8 Q1 and Q2 of 27. Those are the numbers that we have given out. Difficult to accurately predict, as I mentioned, and forecast the numbers precisely. But as I said, structurally we are in a very good position from a macroeconomic point of view, that we should continue to have but for external shocks and risks, which always will be there, we are in for a very long term of good growth in our country.
Governor, you mentioned the fact that the financial sector looks much healthier.
See, barring episodes, there can always be barring episodes, the banking sector is very resilient, very robust. Profitability figures are good, about 14% ROE on an average. Asset quality again is excellent. Net NPA is about 0.5%, again historic lows. Your capital adequacy is good, 17+%. Liquidity again at about 130%. On the whole, if you look at the banking sector, it's quite strong. Governance has improved over the years as a result of various measures taken collectively by the central bank, Reserve Bank of India, and the banks put together.
Right.
And regulation has further, improved, strengthened. Supervision has strengthened. We do a lot of off-site, regular, continuous, with the use of data, use of AI, etc. So supervision has become more precise, better, has become better. It's, so all these things gives us the confidence that the banking sector is much better placed today than it was, 10 years ago. A lot of the credit also goes, apart from, the central bank for its policies, to the central government, which cleaned up the public sector, which provided, the capital for the public sector, and which improved, the governance in the public sector bank. So collectively, I think over the last 10 years, the banking system has certainly improved.
You've talked of India being the fastest growing economy, large economy, and that's very good. But for the public at large, one of the things is great, the numbers look great, but are we getting the jobs that we should be getting? And if you look at that, it does remain a very sensitive issue. There's no doubt about that for every government that's there. From the RBI's vantage point, do you see signs that growth is becoming more employment oriented or employment intensive, or is the economy still growing faster than it is hiring?
Yes, so certainly, employment is a major factor or a major objective for any economy, while of course for us in the central bank it is price stability, keeping in view growth, which is our objective. But one can't overlook employment, which I believe over the years has been doing quite well. If you look at data, and yesterday itself data was released, monthly PLFS report that they now carry out, on a monthly basis. Unemployment rate is down 4.8% or so. It used to be 5.6% as late as May, so it's come down. Even if you look at it over a longer period of time, 17, 18 and thereabouts, the PLFS, the periodic labor force participation rate, the labor force participation rate as per the PLFS, annual PLFS data, used to be in the region of about 60%, is a region of, about 50%. And so from now 50%, 23, 24 to 60%, it has improved, certainly. Of course, there is need. That doesn't mean, that we don't create more jobs. There is certainly, need to create jobs at a higher pace and to create jobs with higher wages going forward. And I think the economy is in good position to be able to do so.
And finally, what keeps the RBI governor awake at night as you enter your second year in it? Was it inflation surprises or global financial instability, fiscal slippages, or domestic credit risk? Which are the ones that say, oh gosh, I got to spend a couple of sleepless nights on this?
So it's been famously said, by a central banker that it's the job of the central banker to worry.
It's to worry, yeah.
So we are constantly on our toes for, the various risks that can emerge from various places. External sector, for example, as mentioned, those risks continue, whether it is on geopolitics, whether it is trade fragmentation, whether it is elevated public debt levels, which can have in some of the advanced countries, which can have spillover effects, higher asset prices, again, in some of the countries, especially related to AI, which can again have, spillover effects, so technology. And domestically, of course, you have weather and climate related events, which we have to be, which we have to take into, which we have to be alert to. Fiscally, you said, I think government is on a good track. They have been consolidating both center and states. I'm quite confident that going forward too, they will continue to improve their balance sheet.
Governor Sanjay Malhotra, thank you very much for this exclusive interview and insightful. We are hopeful that you stop worrying much so we can keep smiling right through the public does. Thank you very much.
Thank you. It's been my pleasure. Thank you very
sir.
much.